We've recently seen production reports from some of the big mining companies, BHP Billiton, Rio Tinto and also Anglo American. It's produced a very mixed bag, but there's a lot going on in the mining sector that nonetheless gives a steer to what we're expecting. Let's take a look at the detail now with Charles Gibson from Edison. Charlie, good to talk to you. There is a big picture thing going on here. I mean, we know about the trade tariffs, which of course is all started with steel and aluminium. There's a lot of concerns now about where that's going. There's a lot of question marks about the global economy, which of course has a big bearing on prices. What to your mind is going on big picture at the moment?
It's very difficult to tell, I think, but what we certainly know is we know that in the US they're raising interest rates. We know that the economy is quite strong there. We have anecdotal stories about people not turning up for interviews. So we've got all of that going on. At the same time, we're talking about potentially a trade war between, in particular, the US and China, which are the two largest trading nations in the world. And at the same time, we've got all that going on. We've got equities, which not only in mining, but generally, if we look at indices and the stock market as a whole, equities which are at a relatively high valuations. In fact, one might almost say, relative to where we think we are in the cycle, they're almost at peak valuations. So there are a lot of things sort of imposing at the moment on stock markets, on the mining sector in general, of which that gives, and you know, these are big sort of tectonic forces, if you like, which are pulling in different directions, and it makes forecasting, I think, very difficult for the economists out there.
Yeah, I want to kick off, if we can, with a look at the copper chart, for example, because I think this says a lot to me about what's happening, and this was mentioned in these recent reports where you get the likes of Rio, which has a lot of exposure, of course, to the copper business, and of course they've been feeling a little bit of pain here. In some respects, they can just up production to compensate for that. But what is this telling us? Because sometimes this gives us a bit of an insight into the global economy.
It's often called Dr. Copper, isn't it? And it's supposed to be a bellwether, if you like, for the global economy. So when the global economy is strong, copper goes up. When the global economy is weak, copper goes down. And you see that very, very sharp drop-off there in the last, month and a half or so, which, you know, in terms of the magnitude of the fall, I think that's taken an awful lot of people by surprise. So we're saying, well, you know, a lot of that, you had to say, has to go hand in hand with tariffs and the expectation of some sort of trade war between the US and China. The one other thing that's going on that pertains to this, although you can argue about the causation, is the yield curve in the US, which we got the Federal Reserve, which I mentioned, which was raising interest rates. Now, those are short-term interest rates, but long-term interest rates aren't moving up at the same rate. So we get this flattening of the yield curve. Now, traditionally, that has been a harbinger of a potential recession. It's probably not in the territory yet where we can say it's definitely saying there's going to be a recession, but it's I would say it's flashing amber on that. And so at the same time we got talk of a trade war, we've also got a financial, what is quite a good historic financial indicator, flashing amber on certainly a potential US slowdown. So those two things coming together, and as you can see the effect it has on the copper price there, and you know, those sharp falls in reaction to it.
How much the dollar is responsible as well for the declines? I mean, let's take a picture here of iron ore as another one where we've got declines. This goes back to the beginning of 2017. Iron ore is on the way down. I think the same picture with zinc and nickel as well. Of course, all these are priced in dollars. What effect has the dollar had, the slight strengthening of the dollar that we've had? You mentioned the rise in US interest rates, and of course the interest rate differential gives an attractiveness to the dollar.
And of course all these things are all connected. So when you have rises in interest rates, particularly in short-term rates, you get strength in the dollar, and then you tend to get declines in prices of things, real commodities, which are priced in dollars. If you want to look at a sort of as pure a monetary effect as you possibly can in metals, that's where you probably want to look at the gold price. Now, you'll see gold has fallen probably less than those. So what you're seeing is you're seeing some effect of the dollar, unquestionably, and that is connected to rises in interest rates. Effectively, that's the dollar going up against everything. But because these metals have moved down more than the gold price, you can probably say that's not all there is. There's something else going on there. And what I would suggest is that's concerns of one, of the slowdown that may be around the corner, and two, obviously, any sort of trade war. Because the expectation is, particularly if there's a trade war between the US and China, what will happen is China won't be able to sell into its sort of finished products or semi-finished products into the US, and then you'll get a backup in China of finished and semi-finished products, and then they won't need there won't be the demand there then for the metals that go into those products. So they can do one or two things. They can stop importing from abroad, or what they can do is they can substitute foreign imports for domestic capacity as well. So those two potential things there. So if we do get a trade war between the US and China, there is the potential to see, if you like, a sort of geared knock-on effect back into these metal prices. Without exception, China is by far the largest consumer of all these metals, and a broad brush figure, you can expect China to be consuming about 50% of global production of any one of these metals.
Is there any evidence that China is beginning to slow down in consumption? Again, very mixed messages coming out of China. I was talking to Edison's economist just yesterday. He doesn't see a problem with China slowing down. That's his impression. But of course, what may be true, and certainly there is no evidence in steel production at all that there is any sort of slowdown at all. In fact, all the evidence anecdotally, when you look at stockpiles, when you look at output, when you look at imports of iron ore, is that the steel production is going ahead as fast as it has ever gone, fairly close to a record pace. So there's no evidence of that at the moment in China. Of course, things could change very quickly, particularly if some of these tectonic plates, these economic tectonic plates that we've been talking about, if they start to shift in any sizable fashion in any particular direction, that could change quite quickly. Yeah. Is there anywhere we could hide in the sector if there is a shift lower, if there is a drop in consumption, if there is a global slowdown?
The one thing I would say is is there any way you can hide in absolute terms and be completely safe? There are very few asset classes that would allow you to do that. But where I would suggest you are likely to find more protection is probably in the gold and in the precious metals, the ones that are less determined in terms of their prices. They're less dependent on industrial production and industrial output. They're much more concerned with monetary forces and interest rates and the values of currencies than they are on industrial production, industrial output. So I would tend to move in that direction. So if you're thinking global disaster, what do I do in terms of the major miners? Well, probably I would suggest the one to go for is Anglo-American, because it has much less of the iron ore, and it has, in particular, a large platinum division. So that's what's going to give you some protection there. Of course, if you want to look outside the major miners, then you can look for pure precious metal plays, and you can look to the likes of Wheaton Precious, for example, which would give you all of what you normally want when you invest in a precious metal stock, but it also gives you protection from rising prices, rising costs, a rising cost base as well. So whilst giving you sort of upside exposure to, firstly, blue sky exploration success and the possibility that metals prices might move higher or might not move down. So I mean, that is the way you can begin to think about it strategically, if you like. On the other hand, if you think that this is all a storm in a teacup and there is smoke but there is no fire, then I would have said the one to go for is Vale, which is probably more exposed than any of the others to iron ore. It's record production in the last quarter. That is also going to expand, and of course Brazil produces a very high quality iron ore which is readily accepted into the Chinese market at a much higher price than the others. Its new mine S11D is the one that is bringing on stream. So if you think that this is a huge new mine that it's bringing on, a very high quality. So if you think that all of these macroeconomic problems are going to go away, it's not that expensive relative to the others. I would say Vale was the one to go for.
Interesting. I was actually reading an interesting anecdotal bit of evidence in Australia that Australia wants to mine things, but in fact they can't actually find the staff to do it. And I know there's this big drive to get new technology and so forth and find new ways of getting things out of the ground cheaper and easier and quicker. But in fact the staff don't appear to be around now either. So is that not going to help? Is that going to push prices up of these metals if there is a beginnings of a deficit because of lack of supply? Or do you not see that as an issue?
The market's quite efficient. And if you get more of a deficit, prices will go up, which will usually allow them to attract the staff. And the Australians are quite clever. One of the things that they're experimenting with at the moment, and Rio has just been doing exactly this, is it's been experimenting with driverless trains, and there are other companies out there which are looking at a small, effectively a small gauge system known as BOSS, and that is more like a road-based system, but again it's one of these autonomous driverless systems. Now actually there's an awful lot of open pit mining, and Rio is certainly one of those that does this already, that is already on a driverless basis. And if you look at Australia and where they do the mining, particularly where they do the iron ore mining, it's a pretty brutally inhospitable place up in the Pilbara there, and we think it's hot in London. It is twice as hot and much less hospitable when you go out there. But that is one of the ways in which the industry is adapting in order to try and address precisely some of these problems. Can you do that, everyone? No, you can't, but you will always be able to attract some people in, and then a little bit of technological change as well, and that just might make the difference. So rather than having to hire people, and you're right, traditionally you had to pay $100,000, and often these are US dollars, or maybe 200,000 for a truck driver in the Pilbara. Well, if you can do without the truck driver, then you're solving two problems with one go.
Big savings. So your base case is what? Positive, green light on mining at the moment, or have you got some question marks? What's your base case at the end of the year and into 2019?
You remember right back at the beginning of the interview, I was talking about peak valuations.
Yeah.
And now one of the things about these, particularly the major miners, what I would say is they're companies you want to buy on a high PE and sell on a low PE. Now that's the wrong way around, if you like, if you think about it traditionally. That's because they're very, very cyclical, and what you find is that their earnings, if you like, are more cyclical than the share price. Now if you look at these big miners, the PEs at the moment, they're about 10 times, give or take, let's say 2. Now that's quite a low PE, so along with that, you say, all right, but the market is relatively highly priced at the moment in terms of price to book. Price to book is close to peak levels. Also, the miners themselves, they tend to perform very well just before a peak, but they're one of the worst performers after the peak. I think there are reasons to be slightly worried. I'm not sure this is the moment to be overweight of the major miners, and as I would say, my inclination is to be cautious and probably look for either junior miners or special situations. And I think that will give you if you want to look at the risk and the reward, that will probably give you a better return for the risk you're taking, given where we are in the cycle at the moment.
What do you mean by special situations, particularly?
Well, either a company is moving from explorer to producer, in which case, within reason, it can probably protect itself. The good news coming from going into production successfully will outweigh anything that's happening in that metal specifically. So that would be an example of a special situation. Or you could look at a special situation like Glencore at the moment, which has this US investigation against it, which has caused its share price to come down. It is, as a result, the cheapest, or one of the cheapest of these major miners. And so again, if you think that that's going to turn out favourably for them, I would say that was a special situation. You can see really probably that investigation has probably cost them £1 on their share price, down from £4 to £3. So if that were to go away, almost regardless of anything else, you'd naturally expect it to bounce back from 3 to 4 again.
Yeah. Okay, all right. Look, Charlie, thanks indeed for joining us for this quick run round and the broad brush strokes in the mining sector. That's Charles Gibson from Edison.
Subscribe to IG for educational content, company insight, financial analysis and expert commentary.